Hello everyone, this is Jennifer. This we are going to continue with the marginal costing problems and solutions. So, first problem, sale of a product amounts to 200 units per month at rupees 2 per unit. So, the selling price per unit is 10 rupees, and how many units have been sold? 200 units. What is your fixed overheads? 400 rupees, and the variable cost is 6 per unit. So, there is a proposal to reduce prices by 10%. Calculate the present and the future PV ratio. How many units must be sold to earn present total profit? So you start with your sales. How many units do we have? 200 into 10 rupees per unit. So total you get 2000 less your variable cost, 200 into 6 rupees per unit, 1200. So your contribution will be 800, which is your balance. 2000 minus 1200. So your fixed cost which they have given 400 rupees total. So your profit will be 800 minus 400, which is 400. So your present PV ratio is equal to contribution divided by sales into 100. 800 divided by 2000 into 100, 40%. So they are telling us to calculate present and the future PV ratio, and the balance, then the break even point, and the is equal to fixed cost divided by PV ratio. Your fixed cost is 400 rupees, PV ratio is 40%. So 40%, so you get 1000 rupees. And they are telling when the price is reduced by 10%. Okay, there is a proposal to reduce prices by 10%. How many units must be sold in order to earn the total profit? So selling price last time it was 10 rupees. So 10 rupees minus 10 into 10%. So you get 9 rupees as your selling price. So let's your variable cost, which is 6 rupees that they have given. Contribution will be 3 rupees. So PV ratio is equal to contribution divided by your selling price. So 3 divided by 9 into 100, 33.33%. So your required sales is what we are supposed to calculate. So the formula is fixed asset plus desired profit divided by PV ratio. So your fixed cost is how much? 400 rupees plus desired profit is how much? 400 rupees, because last time without reducing the selling price we got 400. So this time also we are expecting 400 rupees divided by what is the current PV ratio? 33.33%. So your required sales to be done is 2400. So next question. So analysis of cost of X manufacturing company limited. So analysis of cost of X manufacturing company limited from the following information. So they have given the cost element, which is direct material, direct labor, factory overheads, distribution expenditure, general expenditure. Budget sales for the next year they have given. So we are required to determine the break-even sales volume and the profit in budget sales volume and the profit and actual sales if it drops by 10% and if it increases 5% by budget. So you start with the solution part, which tells total percentage of variable cost to sales. So you have to calculate your total percentage of variable cost to your sales that they have given. So it is direct material we have 32.8, direct labor is 28.4, so factory overheads 12.6, distribution is 4.1, general expenditure is 1.1, which is equal to 79%. Why? This is your total variable cost. Okay, so now total fixed cost is how much? We have fixed cost is factory overheads is how much? 1,89,900 plus distribution expenses 58,400 plus 66,700. Total you get 3,15,000. So your contribution is sales minus variable cost, 100 minus 75%, which is 21%. So your break even sales volume is fixed cost divided by PV ratio. So this 21% is nothing but your PV ratio. So fixed cost is how much? 3,15,000 divided by 21%, which is equal to 3,50,000 into 100 divided by 21, which is 15 lakhs. So profit when budget of sales is 18,50,000. That's what they are asking. So the profit in budget sales, so to be 18,50,000. So profit is equal to sales into PV ratio minus fixed cost. Sales we have 18,50,000 into 21% divide minus 3,51,000. So 18,50,000 into 21 divided by 100 into 3,15,000. So 100 gets cancelled. So 18,500 into 21 minus 3,15,000, which is equal to 3,88,500 minus 3,15,000, which is equal to 73,500. So next they are telling us to find out what is the profit and actual sales if it drops by 10%. So you're supposed to find out your say profit when the sales drop by 10%. So the actual sales is 18,50,000. So if it drops by 10%, 18,50,000 into 10% is how much? 1,85,000. So 18,50,000 minus 1,85,000, sales you get it to be 16,65,000. So your profit is equal to sales into PV ratio minus your fixed cost. So 16,65,000 into 21% minus 3,15,000, which is equal to 34,650. So profit when sales increase by 5%. So sales is 18,50,000. Sales to be increased by 5%. So 18,50,000 in plus 5% of 18,50,000, which we get 19,42,500. So your profit is equal to sales into PV ratio minus fixed cost. So 19,42,500 into 21% minus 3,15,000. So 4,07,925 minus 3,15,000, 92,925. So illustration 12, the following information related to production and sales of an article for Jan and Feb are given. So they have given the sales and the profit and loss. So you are supposed to calculate the PV ratio, fixed cost, BEP, profit or loss account at 46,000, sales and sales to earn a profit of 5,000. So this is a very important question one needs to understand. So we start with PV ratio. PV ratio is nothing but change in profit divided by change in sales. Since we have 2 months given, so you're supposed to find out the changes. So what is your profit? 3,000 minus sales is a negative figure, so minus 2,400 divided by 65,000 minus 38,000 into 100. So you get 5,400 divided by 27,000 into 100, which is equal to 20%. So fixed cost is equal to sales into PV ratio minus your profit. So 65,000 into 20 divided by 100 minus 3,000. So which is equal to 13,000 minus 3,000, which is equal to 10,000. So your break even point formula is fixed cost divided by PV ratio. So fixed cost is how much that we got in the last year? Then 10,000. So what is your PV ratio that we have got? 20,000, which we found out. So 10,000 into 100 divided by 20, which is equal to 50,000. So profit or loss when sales is at 46,000. The profit or loss is equal to sales into PV ratio minus fixed cost. So 46,000 into 20% minus 10,000. So 9,200 minus 10,000, which is equal to minus 800. Since it is a minus, we assume it to be a loss. So what is the last thing that they are telling us to find out is sales to earn a profit of 5,000. So your desired profit level is 5,000. So you will use this formula to calculate your sales. So sales is fixed cost plus desired profit divided by PV ratio. 10,000 plus 5,000 divided by 20%. So 15,000 into 100 divided by 20, which is 75,000. So this is the next illustration. So our next question, the sales and the profit figures of 2 years are given below. So here they have given sales, they have given the profit. They are telling us to calculate the PV ratio. So PV ratio is change in profit divided by change in sales into 100. So what is your profit? It is 25,000 is your last year, 25,000 is your current year minus your last year 20,000. So 1,70,000 is your current year minus 1,50,000 is your last year's sales. Into 100 you get 5,000 divided by 20 into 100, which is 25%. Then we have the BEP, fixed cost divided by PV ratio. Your fixed cost is how much? So if you see in the question, they have given they have not given, so we are supposed to find out the fixed cost first. So fixed cost is equal to sales into PV ratio. So for the current, for the last year, which is 1,50,000 into PV ratio 25% minus your profit, which is how much is your profit that they have given in the equation? It is 20,000. So for any 1 year you can find it out using this ratio. So we are finding it for the first year. So 37,000 minus 20,000, which we get 17,500. So this is your fixed cost. So fixed cost divided by PV ratio. So 17,500 divided by 25%. So 17,500 into 100 divided by 25, which is equal to 70,000. So the sales when profit earn of 40,000. Sales is equal to fixed cost plus desired profit into 100. Profit divided by PV ratio. So fixed cost is 70,500. In the question they have given the desired profit to be 40,000. So divided by 25%, which is equal to 57,500 into 100 divided by 25, which is equal to 2,30,000. So margin of safety, they are giving the profit to be 50,000. So margin of safety is equal to profit divided by PV ratio. 50,000 divided by 25%. 50,000 divided by 25%. So you get your 20 into 100 divided by 25 is equal to 2 lakhs. Profit when sales is equal to 2,50,000. So profit we are supposed to find out because they are telling us the sales to be 2,50,000. So sales into PV ratio minus fixed cost. Sales is how much? 2,50,000 into 25% is your PV ratio minus 17,500, which we will get 62,500 minus 17,500, which is equal to 45,000 rupees. So next illustration. The following information is obtained from Limited for the year 2014-14. Sales they have given, variable cost they have given, fixed cost they have given. You are supposed to calculate the PV ratio, BEP and margin of safety at this level, and also calculate the effect of 10% increase in the sales price. So let us start. Sales they have given 60,000, variable cost is 30,000. So what will be your contribution? 60 minus 30, 30,000. So PV ratio is equal to contribution divided by sales into 100, which is equal to sales minus variable cost into 100. 60,000 minus 30,000 divided by 60,000, which is equal to 30,000 divided by 60 into 100. So your PV ratio is 50%. Break even point is fixed cost divided by PV ratio, which is equal to 15,000 divided by 50%. 15,000 into 100 divided by 50, which is equal to 30,000. Margin of safety is sales minus your BEP. So sales is how much? 60,000 minus BEP is 30,000, so which is equal to 30,000. Next they are telling us calculate the effect of 10% increase in the sale price. So the sale price is increasing by 10%. Sales last year it was 60,000, now it has increased by 10%. So 60,000 into 10% is 6,000. So 60 plus 6, 66,000. So your PV ratio is equal to sales minus variable cost divided by sales into 100. So sales minus variable cost is contribution, 36,000 divided by 66,000 into 100. You get 54%. BEP is fixed cost divided by PV ratio, 15,000 divided by 54.55%. So your BEP is 27,498. What is your margin of safety? Sales minus BEP. So 66,000 minus 27,498, which is equal to margin of safety is 38,502. So your next question, Limited manufactures and sells three products A, B, and C with a sales mix of 33 1 by 3%, 16 2 by 3%, and 50% respectively. So the total budgeted sales during the month of December 2014 is 2 lakhs, which is 2000 units. The following are the operating cost. So they've given fixed cost, they've given the variable cost. You're supposed to calculate the BEP for the product on an overall basis, and what will be the BEP in the sales mix if it is changed as follows. So the BEP is changing to be 33.3% for all the three. So we'll start with marginal cost statements. First you start with your total sales. Okay, total sales is how much have they given in the question. Total sales they have given it to be 2 lakhs. So 2 lakhs, which is for 2000 units, less your variable cost. This is our normal format, right? To a sales minus variable cost we get contribution, contribution minus your fixed cost you get your profit. So variable cost, if you see, the variable cost is changing. So it has a sales mixture, manufacture and sells three products with a sales mixture of so and so, and the variable cost is 70% of so and so. So 2 lakhs into 33.33% into 70% of these sales, which is 46,662. B, which is 2 lakhs into 16.67 of your manufacturing of sales mix into 60%, which is 20,004. C is 2 lakhs into 50% into 65%, which is 65,000. Total you get 1,31,666. So what is your contribution? Sales minus variable cost, which is equal to 68,334, is nothing but your contribution. Now less your fixed cost. Fixed cost they have given in the question to be 50,000. So 50,000, which you get profit to be 18,334. Now they are telling, now we are supposed to calculate our PV ratio, contribution divided by sales into PV ratio. 68,334 divided by 2 lakhs into 100, which you get 34.17%. BEP is fixed cost divided by PV ratio. 50,000 divided by 34.17%, which you get 1,46,000, which you get 1,46,000. 50,000 into 100 divided by 34.17, which is equal to 1,46,327. So when marginal cost statement of the projected sales mix, so you're supposed to prepare the marginal cost of the projected sales mix. So total sales is how much? 2 lakhs, which remains the same. The variable cost is 2 lakh into 33.33%, which is our new sales mixture. Okay, into 70% into 60% into 65%, you get 1,29,987. Contribution will be 70,000 and 113 minus your fixed cost 50,000, so your profit is 20,013. So again your PV ratio is contribution divided by sales, which is equal to 70,013 divided by 2 lakhs into 100%, which is 35%. BEP is fixed cost divided by PV ratio, 50,000 divided by 35%. 50,000 into 100 divided by 35 divided by 35, which is equal to 1,42,857. So PV ratio has been increased from 34.17 to 35% as the sales mixture is changed. Hence for the company, sales mixture is very important. So in next illustration, which tells a retailer deal in an garment is currently selling 24,000 shirts annually. He supplies the following details for the year ended 31st December 2014. The selling price per shirt is 400, variable cost per shirt is 250, fixed cost it includes salaries for the year 12 lakhs, general office cost for the year 8 lakhs, advertisement a cost for the year 4 lakhs. So what is your fixed cost? 12 plus 8 plus 4, which is equal to 24 lakhs is your fixed cost. So you're supposed to calculate BEP, margin of safety. So first let us calculate the BEP and margin of safety in sales revenue. and the number of shirts sold. So BEP in units is nothing but your fixed cost divided by contribution per unit. So what is your fixed cost? 24 lakhs divided by contribution. What is your contribution? 150. How did you get this 150? So 400 is your selling price minus 250. So the balance is 150. So what is your BEP? 16,000 shirts. So fixed cost is equal to 12 lakhs plus 8 lakhs plus 4 lakhs, which is 24 lakhs. Contribution per unit is selling price per unit minus variable cost per unit, which is 400 minus 250, which is 150. So if you do this, you get 16,000 shirts. So break even point in value, which is your sales. So 16,000 shirts at rupees 400, so which is equal to 64 lakhs. So break even value, which is equal to fixed cost divided by PV ratio, which is so before that you're supposed to find out your PV ratio. PV ratio is what? Contribution divided by sales into 100. 150 is your contribution divided by 400 into 100. 37.5%. So fixed cost divided by 37.5%. Fixed cost is 24 lakhs divided by 37.5%, which is equal to 64 lakhs. Moving on to margin of safety in units, actual sales minus your BEP. So actual sales we are estimating it to be 24,000 shirts minus your 16,000 shirts. So you get 8,000 shirts as your margin of safety in units. So what is your margin of safety in volume? So into 400 rupees, so which is equal to 32 lakhs. So net profit when 20,000 shirts were sold. Okay, so you have your sales is equal to fixed cost plus desired profit divided by PV ratio. When are we supposed to basically use these formulas? When they tell us to find out the profit for so and so. So it is like a desired profit that we are supposed to find out. So 20,000 shirts into rupees 400, which is equal to 24 lakhs plus desired profits divided by 37.5%. So 80 lakhs into 37.5%, which is cross multiply, which is equal to 24 lakhs plus desired profit. Therefore 30 lakhs is equal to 24 lakhs plus desired profit. Therefore desired profits is equal to 30 lakhs minus 24 lakhs, which is equal to 6 lakhs. And they're telling sales when profit is 1,50,000, an increase in variable cost, which is selling commission. So sales is equal to fixed cost plus profit divided by new PV ratio. Therefore new PV ratio is equal to sales minus new variable cost divided by sales. So we are supposed to find out the PV ratio. 400 minus what is your new variable cost? 280 divided by 400. How did you get this 280? Is they're telling the third if it is desired to introduce selling commission of 30 rupees per shirt. So what is your variable cost earlier? It was 250. So 250 plus 30 is nothing but your new variable cost. So 400 minus 280 divided by 400 into 100, which is equal to 30%. So what is your sales? 24 lakhs plus 1,50,000 divided by 30%. So 25 lakh 50,000 divided by 30%, which is equal to 85 lakhs. So number of shirts sold is 85 lakhs divided by 400 shirts is equal to 400 rupees, which is equal to 21,250 shirts. So break even point in number of shirts in sales volume and fixed cost is increased by 3,30,000 and selling price by 15%. So what is your new selling price? It is increased by 15%. So 400 plus 15% increase, which is equal to 460. So what is the new variable cost? 24 lakhs is your whole fixed cost divided plus your 3 lakh 30,000 is your new fixed cost, which is equal to 27 lakh 30,000. So what is your new contribution or unit? So new selling price minus variable cost, which is equal to 460 minus 250, which is equal to 210. So BEP in units is new fixed cost divided by new contribution or per unit. So 27 lakh 30,000 divided by 210, which is equal to 13,000. So BEP in sales volume is equal to 30,000 shirts into 460, which is equal to 59 lakh 80,000. So next question is a graphical question. So you are given the following data for the year 1997 or a factory. So output they have given, fixed expenses they have given, variable expenses, selling expenses. So you're supposed to draw a chart and you're supposed to put it in your graphical representation. So BEP in units is equal to fixed cost divided by contribution per unit. So what is your contribution? Sales minus variable cost. So 20 rupees minus 10 rupees, which is equal to 10 rupees. So BEP in units is 2 lakhs divided by 10 rupees, which is equal to 20,000 units. We are supposed to calculate the desired sales in units when selling price is reduced by 10%. So present profit is equal to contribution per unit is how much? 10 rupees. So total contribution is 40,000 into 10, which is equal to 4 lakhs. Fixed cost is equal to 2 lakhs. Profit is equal to 2 lakh. The new selling price is 18 rupees and the new contribution is 8 rupees. So desired sales is fixed cost plus desired profits divided by contribution per unit. So they are telling selling price is reduced by 10%, right? So 20 rupees into 10% is 2 rupees. So 18 rupees will be your minus your 2 rupees. 18% will be your new selling price. So 18 minus your variable cost. So what is your variable cost? Variable cost is 10 rupees. 18 minus 10 is 8 rupees is your new contribution. So that is how you got. So 2 lakhs plus desired profit is 2 lakhs divided by 8, which is equal to 4 lakhs divided by 8. 4 lakhs. So 2 lakhs plus 2 lakhs divided by 8, which is equal to 4 lakhs divided by 8 is equal to 50,000 units. So output, first you have output, second is your variable cost, third is your fixed cost, fourth is your total cost, and fifth is your sales. So if it is zero output, your variable cost also will be zero. So your fixed cost will remain same irrespective of what they outputted. So it is 2 lakhs. So variable cost plus fixed cost is equal to total cost, which is 2 lakhs. So sales, you do not have anything in the first. Second is when your output is 10,000. So what is your variable cost? When the output is 10,000, so how many units you have? Variable cost, variable expense per unit is 10 rupees. So variable cost is 10 rupees. So 10,000 units into 10 rupees, 1 lakh. So 2 lakhs remains same. Total cost is 1 plus 2 lakhs, which is 3 lakhs. So your sales is, what is your sales per unit value? So your selling price is 20 rupees per unit. So 20 into 10,000, 2 lakhs. So for a 20,000 unit, variable cost is 2 lakhs. How do you get this variable cost? 10 rupees per unit. So 10 into 20,000 is 2 lakh. Fixed cost remains same. Total cost is 2 lakhs plus 2 lakhs, 4 lakhs. Sales is equal to 20 into 20,000, which is 4 lakhs. So in the same way, when you do, we get for everything. And your break even chart will always be your units in your x-axis and your rupees in your y-axis. So if you see your total sales line goes up, so it is 10,000, 20,000, 30,000, 40,000 units. So in that you go up by 2 lakhs, 4 lakhs, 6 lakh and 8 lakhs. And your total cost line starts with 2 lakhs. Why? Because it is with your fixed cost. So you start with 2 lakhs, 3 lakhs, 4 lakhs, 5 lakhs and 6 lakhs. So by this we end with our marginal costing. Thank you everyone.